Inflation surges to 3.3%. Impact on mortgage rates and housing market. In the wake of Canada's surprising inflation surge, all eyes are on the Bank of Canada and its potential decision to once again raise the overnight bank rate. This crucial move could have a domino effect, particularly on Canadian mortgage rates, subsequently influencing the nation's housing market and the trajectory of house prices. As the Bank of Canada contemplates its next step in the face of elevated inflation, the possibility of another rate hike in September looms large. Such a move would inevitably translate into an upward trajectory for Canadian mortgage rates. As the central bank strives to strike a balance between controlling inflation and ensuring economic stability, the repercussions for borrowers seeking mortgages could be significant. Higher mortgage rates would likely lead to increased borrowing costs for homebuyers and those looking to refinance their existing loans. Potential homeowners may find themselves facing higher monthly payments, reducing their purchasing power and altering their affordability calculations. The real estate landscape could witness a cooling effect as potential buyers are deterred by the prospect of pricier mortgages. The Canadian housing market, which has been marked by fervent activity in recent years, could experience a noticeable shift if the Bank of Canada's anticipated rate hike materializes. Elevated mortgage rates might lead to a slowdown in housing demand, subsequently impacting sales figures. In turn, a potential decrease in demand could exert downward pressure on house prices, introducing a recalibration to a market that has witnessed soaring prices in various regions. Local housing markets, which have demonstrated varying degrees of resilience and growth, may face differing outcomes based on factors like regional economic conditions, housing supply, and local demand. While some areas might experience a more pronounced softening, others may remain relatively stable due to sustained demand and limited inventory. As the Bank of Canada's decision-making process unfolds, industry experts and stakeholders are closely watching for signals that could provide insights into the central bank's intentions. Homeowners, prospective buyers, and investors alike are assessing the potential impact on their financial situations and investment strategies. Should the Bank of Canada move ahead with the rate hike, it will likely underscore the importance of staying informed and adaptable in a dynamic economic landscape. In summary, the possibility of the Bank of Canada raising the overnight bank rate in September carries significant implications for Canadian mortgage rates, which in turn could influence the broader housing market. A rise in mortgage rates may curb demand, leading to a potential cooling effect on housing activity and affecting house prices. As Canadians await the central bank's decision, uncertainty and cautious optimism pervade the discussions surrounding the future of the housing market. Canada's inflation surges to 3.3%. Implications for economy and Bank of Canada. In recent news from August 15, 2023, Canada's annual inflation rate has taken an unexpected and concerning turn. The Consumer Price Index, CPI, recorded a sharp increase of 3.3%. Surpassing economists' expectations and posing challenges for the Bank of Canada's upcoming rate decision. Gasoline prices, mortgage interest costs, and other factors have played a pivotal role in this surge, potentially impacting various aspects of the Canadian economy. This video and news articles examine the details of this inflation surge and its potential implications. Financial Post, Canada's inflation rises at faster pace than expected, August 15, 2023. Published by Financial Post staff. Canada's inflation rate exceeds expectations. The Consumer Price Index, CPI, witnessed a substantial rise of 3.3% in July compared to the previous year, following a 2.8% increase in June. This acceleration has startled economists, who were anticipating a more modest rise of 3%. The unexpected surge places the annual inflation rate above the Bank of Canada's target range of 1% to 3%. Factors behind the inflation surge. Gasoline prices played a significant role in this inflation spike, with a notable year-over-year decline of 12.9% in July after experiencing a sharp 21.6% drop in June. This trend is due to the base effect, a reversal of a significant decrease in pump prices in July 2022, which no longer factors into the annual calculation. Additionally, energy prices saw a deceleration in their contribution to inflation, dropping to 4.2% from the previous 4.4% in June. Economic implications and Bank of Canada's dilemma. This surge in inflation presents a dilemma for the Bank of Canada. While economic indicators like unemployment rates and consumer spending have shown signs of cooling, the unexpected inflation figures may pressure the bank to reconsider its stance on interest rates. The Bank of Canada's preference to stay on the sidelines in September and assess the effects of prior rate hikes could be challenged by these new figures. CBC News: inflation jumped higher last month to 3.3%. August 15, 2023, published by Pete Evans. Gasoline and energy prices impact on inflation. The inflation rate's unexpected rise to 3.3% is attributed to several factors, with gasoline prices being a key driver. A significant drop of 9.2% in pump prices in July 2022 had previously led to a decrease in overall inflation. However, the base effect has worn off, resulting in gasoline's diminishing role in reducing the inflation rate. Moreover, electricity prices surged by 11.7% in the past year, with a doubling of electricity bills in Alberta being the primary cause. Continued rise in living costs. The cost of living continues to rise in Canada, especially in terms of groceries, which increased by 8.5% in the year leading up to July. Additionally, mortgage interest costs escalated by a staggering 30.6% over the past year, significantly contributing to the overall increase in inflation. The Star: Canada's inflation rate rises to 3.3% in July on higher mortgage costs. August 15, 2023, written by Josh Rubin. Mortgage costs and inflation. The inflation rate surged to 3.3% in July, up from 2.8% in June, is a cause for concern and could prompt the Bank of Canada to reconsider its interest rate decisions. One of the major contributors to this rise is the increase in mortgage interest, which surged by 30.6% over the past year. Excluding mortgage interest, the inflation rate stood at 2.4% in July. Bank of Canada's response. Analysts believe that the Bank of Canada may feel compelled to raise interest rates further due to the strong performance of Canada's economy. The bank's aggressive rate hike campaign, initiated in March 2022, aimed to curb inflation and stabilize the economy. The overnight lending rate has climbed from 0.25% to 5% in just over a year, with further rate hikes potentially in the pipeline. Canada's unexpected inflation surge to 3.3% has raised concerns about its potential impact on the economy and the Bank of Canada's monetary policy. Gasoline prices, energy costs, and mortgage interest rates have played a significant role in driving up the inflation rate, prompting discussions about the bank's upcoming decisions on interest rates. As inflation rates remain above the bank's target range, the balance between economic growth and inflation control becomes a crucial consideration for policymakers. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.